Did you ever have a trading idea where you were sure a stock was about to go down, but you just couldn't find the right risk reward to do a safe trade without risking more than you could make if you were right? I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders at our firm are faced with this issue all the time. But the good news is that they're trained on how to handle this exact situation through the strategic use of options in a way that's not really that hard to learn. So if you're interested in learning how to execute a trading idea that you're dying to make, but you just can't make the risk reward work out responsibly, then stick around. This is going to open up a whole new way for you to trade that you might never have thought was possible. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so if you follow the markets at all, you're probably more than aware of the fact that the market didn't exactly take kindly to the most recent earnings report issued by Facebook, which is now known as Meta, of course. And as you can see, the stock opened up an incredible 24% down off its previous close, and then just days later had fallen a further amount, closing at 232 on February 9th. Now, one of the traders on our desk was under the belief that FB was going to sell off further and at least retest that 220 level that it had hit the day before. But at the same time, every trader on our desk is trained to consider the possibility that they're wrong on their thesis and to plan a technical point where the trader has to accept that his thesis is wrong and that the stock, instead of selling off further, has instead begun to bounce. And so this trader selected the 248 intraday high from a week earlier, which was the highest price at which FB had traded since the earnings report disaster a week earlier. And so what you'd need to consider as a trader at this point is whether you have a viable trade or not. And a viable trade always has a reward that is multiples of the risk that the trader's taking on. And so if you look at the reality of this trade, the risk-reward trade-off is just not conducive to a properly designed trade. The risk is actually greater than the reward, which doesn't work for a day or swing trader. However, this trader has knowledge of options trading and wasn't so quick to give up on this idea. And in fact, using options, what would have been an unacceptable risk-reward trade-off, can in many cases be turned into a very viable trade if you have the proper training to understand exactly how that can take place. Now, before we get into how using FB options can resolve the unfavorable risk-reward trade-off on this trader's thesis, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. In order to explain to you how options can be used to turn the risk-reward trade-off on a trading idea in our favor, we need to make sure that everyone watching the video understands how put options on stocks work. If you already know how they work, just hang in there. This is going to be quick, and then we'll jump right back into the lesson. All right, so what's known as a put option on a stock entitles the buyer of that option to sell 100 shares of a stock that he owns at a certain price called the strike price of that put option, regardless of what price the stock is actually trading at when he exercises that right. The buyer of the put option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way below the strike price of that put option, in which case the buyer can exercise his option and force the put seller to buy his shares at the put option strike price, which is higher than where the market is trading, causing the seller's account to get marked down. So even if the market goes way below the strike price of the put option, the buyer of that put has the right to sell 100 shares of that stock at the strike price of that put, so he'll get way above market price for those shares by virtue of owning that put. And so the premium of the put option reflects the risk that the market thinks the put seller has, that the shares will be going much lower than the strike price of the put. So all other things being equal, when a stock price goes down, the price of a put option for that stock will go up because the put seller's chances of taking a loss because the market has blown through its strike price gets larger as the stock's price continues to drop. And just one more thing, if on the day of expiration, the stock closes above the price of that put option, then that put option expires worthless because no one is going to exercise their right to sell a stock at a price lower than it's selling in the open market, so it just expires worthless. Okay, so keeping that in mind, let's say that on the close on February 9th, which as we mentioned before was 232, the trader, instead of selling shares of FB, he instead bought 10 FB puts at 225, expiring a few days later on February 11th. And so let's take a look at how that has affected the risk-reward trade-off of the situation. You see, let's consider the two basic scenarios that this trade presents to the trader. And in the first scenario, the stock bounces above 248 and continues rallying so that by expiration the stock closes at or above 248. Well, that's the worst case scenario because, as we mentioned before, the puts just expire worthless because no one is going to exercise their right to sell their shares of FB at 225 when they can be sold in the open market above 248. So the trade would just close for a loss of 1190. But let's now consider the second basic case, which is that the trader is right and the stock closes at 220 on expiration. What would the options be worth at that point? Well, as you can see from this slide, you'd start by subtracting the closing price of 220 from the strike price of 225. Why? Because if we owned 100 shares of FB and held that put, we could simply exercise our right to sell those shares at 225, even though they are only worth 220 in the open market. And so our account value would automatically increase an equivalent of $5 per share. But remember, each put option represents 100 shares of stock, so you multiply that by 100, and we own 10 of those puts, so you multiply that by 10, and so at the close of that day, those put options would be worth $5,000, as you can see from the calculation. And so dividing that $5,000 value by the maximum risk on the trade, which is the full options premium of $1190, you can see that the reward to risk for this trade is 3.2 to 1. Whereas when you compare that same risk-reward relationship on the stock trade, it's actually less than 1. And so what was really pathetic risk-reward relationship with a stock becomes a very satisfactory risk-reward for a swing trade. Now, let's move to February 11th, which is the day these options expire. And as you can see, in fact, the trader's thesis was right, and the stock sold off below 220 down to 219.55. And so at expiration, we can put a final value on these options. And just like in that previous calculation, you subtract the put strike price from the closing price of FB and multiply it out like we did before. And as you can see, the final outcome is a profit of 42.60, which actually exceeds the approximate reward to risk situation that we talked about earlier. And so what I'd like you to take away from today's video is that if you have a solid trading idea, but the risk reward just doesn't work out when trading with stock, you need to start thinking about using options for that same trade, as in many cases, the risk reward puzzle is solved with options as long as you get the timing right also, while the trade just isn't appropriate using shares of stock regardless of when your expected move happens. And that's why professional traders learn how to trade options, so they can open up their playbooks to lots of different trades without violating their risk-reward standards, which is critically important, as any successful trader well understands. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now before you miss it.